The 2024 elections have come and gone. As the dust settles and the results trickle in, Republicans have gained control of the House, Senate, and presidency for the first time since 2007. Some investors fear that a three-way Republican majority will mean groupthink, a government unchecked, and a one-sided legislative agenda that does not serve all interests. It is important to understand, while the Republicans have a majority in both the House and Senate, it is by a small margin only, and any significant legislation will need bipartisan cooperation. The recent Senate leaders' election also offers some perspective on the independent-mindedness of the members of Congress. The senators chose an experienced operator in John Thune over Donald Trump's favorite candidate, Rick Scott, who finished third in a three-way race. One of the most dangerous things to do in investing is to rely on sound bites, rhetoric, and a superficial understanding of the issues impacting companies, industries, and the markets. While President Trump has been anything but equivocal about his agenda, which is based on an increase in tariffs, tougher enforcement of immigration policies, both considered inflationary, he is also a proponent of lower taxes, deregulation, and abolishing incentives for clean energy and favoring traditional fossil fuels. At this point, it's just rhetoric, and there are many other variables in play. For lasting policy changes, first, his cabinet nominees need to be confirmed. Expect a bruising confirmation process as the Democratic senators, smarting from the results of the recent election, extract their proverbial pound of flesh. I believe one of the first things on President Trump and the congressional agenda will be to tackle the imminent sunsetting of the Tax Cuts and Jobs Act of 2017. If the act sunsets, it will mean higher tax bills for almost 62% of taxpayers, higher corporate taxes, lower thresholds for estate tax exemptions, and elimination of bonus depreciation allowances. The pain felt would be bipartisan, and I believe that the fine art of horse trading will be on display here. In return for lower marginal tax rates, the Republicans may be willing to give ground on the $10,000 cap on state and local tax deductions. There could be give and take on things like corporate taxes, estate tax thresholds, taxes on tip income, deductions for auto loans, etc. Let's look at some industries experiencing major movements following the election. Traditional energy stocks have caught a bid, and renewable energy stocks seem to be plumbing new lows. Drill, baby, drill seems to be the rallying cry among investors who think drilling activity in the U.S. will pick up dramatically. The harsh reality is that increased drilling activity will not lead to a dramatic boost in crude oil output. Some of the best oil fields have already been discovered and exploited. There are geological limits to unchecked growth in pumping of oil. Energy companies are no longer the wildcatters of yesteryear and are disciplined capital allocators, unlikely to destroy their balance sheets and compromise cash flow. The Inflation Reduction Act that provides subsidies to renewable energy will be hard to reverse given the slim Republican majority in both chambers of Congress. Onshore wind and solar are one of the cheapest sources of electricity, and the largest portion of the installed base is in the red Sunbelt states. Installation activity creates jobs, and jobs keep constituents happy. And happy constituents get our legislators reelected. On the topic of immigration, it is important to point out that the U.S. farming sector relies heavily on immigrant labor. Many of these workers are illegal. Interestingly, the farming lobby is heavily Republican, and farmers, as business people, will likely oppose any large-scale deportations. It is more likely that the first wave of deportations will focus on those who were convicted of felonies, violent crimes, and those who have pending deportation orders. I personally do not believe that we will reach the point where we will see families being forcibly separated, inhumane and cruel deportation policies enacted. So it is unlikely we will see a marked inflationary influence via higher prices on agricultural products. The construction industry could suffer from a shortage of workers in the event of stricter enforcement, and we could see slower construction activity. The impact of tariffs is much harder to precisely quantify. It seems that we as a nation have a poor grasp on mathematics and understanding of how trade works. People have concluded that the prospect of 10% across-the-board tariffs and up to 60% on Chinese products will be inflationary. First, tariffs per se may not have as much inflationary impact in a highly competitive world, as businesses may choose not to pass through higher prices to retain market share. Second, here's the way trade math works, and I'm relying here on the analysis done by Dr. David Kelly of JP Morgan. 38% of goods imported by the US come from countries where the US has bilateral treaties, and unilateral tariff increases are barred, mainly Mexico and Canada. China, which seems to be in the proverbial gun sights in the trade war, accounts for about 16.5% of US imports. The same is true in reverse. US accounts for about 16.3% of Chinese exports. China accounts for only 7.5% of US exports. All of this means is that China has more to lose in an all-out trade war with the US and will be motivated to come to the bargaining table. According to Dr. Kelly's analysis, assuming an approximate 9% increase in tariffs, imports, which account for 17% of consumer spending, could add approximately 0.7% to inflation as measured by CPI. Yes, an upward tick for sure in the short term, but not an all-out disaster as many would believe. This is based on the worst-case scenario. However, the long-term benefit is that manufacturing could return to the US and grow employment over the long term. The picture on consumer spending is mixed, as evidenced by the good earnings and positive report from Walmart, contrasted by Target, which, as the expression goes, puked their earnings report and guided downwards. Retail stocks could be hurt on the margin by increase in tariffs against a soft consumer backdrop. Investor reaction to Robert Kennedy Jr.'s nomination to be Secretary of Health and Human Services is exemplified by the term big picture fallacy. Healthcare stocks have sold off in a big way on the belief that RFK Jr. is likely to impose extreme rules that will destroy the industry. A closer look at his position shows that he is not universally anti-healthcare industry, but has views that are actually positive for healthcare long term. He wants greater visibility on pricing and clinical results. He wants to encourage the research and inclusion of alternative health treatments. He wants to focus on preventative healthcare. While there will be winners and losers, remember the need for healthcare, unlike a decision to buy a brand new OLED TV, is not discretionary. I'll close here by reminding viewers that a well-developed long-term investing plan is the best way to grow your wealth. Stick to the plan and make minor strategic changes. As the old saw goes, time in the markets, not market timing, is the recipe for success. Thanks for listening.